Welcome back, bro. This is the third lesson, and then we are starting off from the forex analysis. So now we are getting into a little bit deeper again. We are now getting into the space, and then how everything works and how you can also approach it in how I do. So now is forex analysis, and then we have three main types of analysis. Then you have to choose one type of analysis you can or you will use to approach the market. So with the three types of analysis, or three main types of analysis we have the technical analysis, we have the fundamental analysis, and then we have the sentimental analysis. The technical analysis overview is the technicals, you being on trading view, and then you using your trend line, your vertical line, your Fibonacci, your Bollinger Bands, and then those technical tools to just mark on the chart and then make decision, either price will go up or price will go down, is technical. And the fundamental analysis is the economy, the macro and then macroeconomic news, and then the activities that happen in a certain countries. You can also use them to also capitalize on the market. And then the sentimental analysis is also about, it's like, I don't really know like how to explain this sentimental one, but the sentimental analysis, I don't really like want to just say anything that is not really the right thing. So it is also down there. When I get there, I'll also explain it for you to also understand. So that's the main types of the forex types, the analysis. Yes, so let's start off from the fundamental analysis. So the fundamental analysis is the process of forecasting price movement in market using important political or economic news release which directly affect the behavior of the currency. So the fundamental analysis is using the economic news, the political news released in a certain country to make the decision on the market. You understand? So the fundamental analysis, when a news is released in maybe the United States, do you understand? Or let me use Ghana for example. For Ghana example, let's say when GDP, that's the gross domestic product, goes high, meaning at that moment our economic growth on GDP has go high. Do you understand? And it has direct impact on our currency, and our currency will also go up. Do you understand? So you just capitalizing on the increment of the GDP, that's the gross domestic product, to make a decision. The market will go up. Do you understand? You just buy, and when the market go up, you make your cash from that. So this is done based on macro and macroeconomic indicators, as well as the news background. As I said earlier, the news are basically the macro and then macro and macroeconomic activities or news. So that's just it. And then fundamental analysis is tracked using economic calendar. So how are you going to be able to see the fundamental analysis or news that will be released in a certain country, Ghana, US, Canada, Japan, and all other countries? How are you going to see them? Unless you use the economic calendar. Do you understand? And the economic calendar, we have a specific website that we always go there, and then when it's released, we can know if either it is up or down. So we get to know it when as we go on. Economic calendar is a tool used by traders to keep up with each country news release. It is a table displaying date, time of the news, currency, the expected impact on such currency, which will be high, medium, or low. So the economic calendar, as I said, is a website or maybe a tool. It's a website or a tool that we traders we use to track the release of the news. Do you understand? And the release of news, it contains the date, the time, the type of currency that the news is coming on. Do you understand? And then if it's high impact, you will see. If it is low impact, you will see. And if it is medium, you will know based on the color of the box. You get to know when we keep on moving down. So for example of a popular economic news release is the United States America non-farm payroll. That's the NFP. So one of the most popular news release or economic news release is the United States non-farm payroll, which is the NFP. And then the NFP is released on every first Friday of every first Friday of every month. The non-farm payroll is released and is one of the highest news impact of the economic news in the United States. The economic news forecast has great impact on Euro USD and some other USD pairs, and because it is coming from this NFP, that's the non-farm payroll, is coming from the United States. Every currency that has United States as a base or let me say every currency that is paired with the United States currency, the non-farm payroll has an impact on it. That's just it. And then this is the website that we use in tracking of the news release. You can see we have a lot of news release here. We have a lot of news release here, and then each box, you see we have a yellow box, and then we have like a red box, and then an orange box also. So each of the box color explain what it is. So this page is called Forex Factory. So we have Forex Factory and then my FX book. You understand? We have the forexfactory.com and then my FX book. So that's where we use in tracking of the news release. That's where we use in tracking of the news release. That's the forexfactory.com and my FX book, my fxbook.com. So now let's get into the technical aspect, the technical analysis. So when you say the technical analysis, it is a method of forecasting the currency pair behavior based on its past movement. Technical analysis believes analyzing patterns in price history is enough to determine the high probability trade setup. If price reflects all the information that is in the market, then the price action is all one needs to really make a good trade. Well, because history, they say, trends to repeat itself. And as a result, it is mostly widely used type of analysis. So with the technical analysis, we use past movement in the market to predict what will happen in the future or what will happen. You understand? So the technical analysis, which is also known as the price action, pure price action, is the one which is widely used. The technical analysis is the one which is widely used. So the technical analysis simply means using the history or past movement in the market to predict or analyze the future, because we believe what has happened in the past can eventually happen in the present. Do you understand? For example, in football, we can justify that because Real Madrid or Barcelona is capable of winning La Liga and then Champions League. So when they get into the La Liga and then the Champions League stage, maybe every individual take them to be the favorite. Do you understand? Because of the past history, because of the past glories they have already made, because of the trophies and then those stuff they have already achieved in the past. We use them to predict the future because it is probably that it can happen again. That's basically how the technical analysis entails, and the technical analysis also has or use an indicators. I'm just letting you know because me personally I don't use any indicator. I use only just pure price action in everything in my analysis. Just pure price action. I don't know, maybe in the future I'll try um one of the two and see whether it will work out for me. But now currently I'm not using any indicator. So let's say technical analysts also make use of indicators like the relative strength indicator. We have the Bollinger Bands and then a lot of those indicators that are also used to determine the future price direction of the market. And then we have the sentimental analysis. So with the sentimental analysis, the market is a place that represents all of the traders and what they feel for the market at the same time. The traders' feelings and trade position forms the sentiment of the market. The market is made up of mixed feelings, various ideas and trade bias. This makes it really difficult for a retail trader to make it difficult for a retail trader to move the market to his or her favor, no matter how strong your opinion might be. If more people do not think so, your analysis will be proven wrong. That's the market for you and nothing a retail trader can do about it. You have to be cautious of what the market is making up of. Think like the big players to make money like them. Keep in mind how the market feels and gauge it into any trade that you make or the trading strategy that you use. Let me end it here. Learning the gauge of the market and sentiment is a multi-billion skill set. Learning the movement, this literally means learning the market. Learning the skills is a multi-billion skill set, and this can be gained through consistency. This can be gained through consistency study of the market and putting into consideration how the big players act, and then you react in line with the market sentiment. So the sentimental analysis basically really means how you, the trader, personally feels, and then the trade position that you take. There are some people, they don't really analyze, they don't do nothing, they don't follow the fundamental, they don't follow the technical. They will just be watching the market and then how they feel. If they feel the market will move up, they just enter buy. If they feel the market will goes down, they just enter sell. So the sentimental analysis really is like the feeling that one has to really enter a position. Like I said earlier, if one feels the market will goes up, he just hit on the buy, and if he feels the market will goes down, he just hit on the sell. And then the one thing is that you as a retail trader, you can't move the market. you can definitely never move the market. You can have the right setup, you can have the right setup, the right analysis and everything. Because you're a retail trader, you can never move the market. So the only thing you can do is that trade in the direction of the big players, trade in the direction of the hedge fund, trade in the direction of the big players in the market. Trade in the direction of them, so that you also can make money from the forex market. So the sentimental analysis basically means the trader, how he feels, and then he will just be there and then be like, I want to sell, then I want to buy, and then he will just go in for that. That's it. And then which type of forex analysis for trading is best? So upon all, so these three types of forex analysis, which one is the best? Everyone has his own opinion. So someone can say the fundamental is the best cause I make a lot of money from trading news. Someone can say the technical cause the price action is always right, and then someone can say the sentimental analysis is also the best because his feelings, and then when he say buy it goes by, when he say sell it goes. Everybody has his own opinion. So let's read what is here. Here comes a controversial question. Just as we have in other spheres of studies, one-sided extremism has no chance in forex trading, because as you advance in your journey as a forex trader, a lot of opinion will come up. Do not be deceived. Do not be deceived. No one is wrong or right in it entirely. Do you understand? Someone say technical, someone say sentimental, someone say fundamental. Don't just pinpoint say fundamental is not right, technical analysis is not right, sentimental analysis is not right. You cannot pinpoint it simply because the type of analysis everybody makes, he makes money from it. So you can't just say that your technical analysis is better than the fundamental or the sentimental. If the technical analysis, which is the price action, is working for you, just stick to it. If the fundamental is working for you, just stick to it. If the sentimental is working for you, just stick to it, and then push harder to make like ends meet for yourself. That is the goal. The goal is just to make money. The goal is for the freedom, bro. It's just for the freedom. It's not for the money. It's just for the freedom. You can go anywhere you want. You can do everything you want at any time, because the forex market will not run away. It's always there for you 24/5. Do you understand? So the goal is not for the money, but the goal is for the freedom. And where freedom is, there's always enjoyment. Let's continue. That's basically it. Everyone is only predicting, and the market reward the person who is able to merge all these three analysis and apply them hand in hand to come up with the best trade ideas. Everyone is predicting the market, but the best person or the best trader is the one who is able to merge these three, the technical, the fundamental, and the sentimental. Is able to merge the three ones hand in hand. Do you understand? To make the best trade ideas. Do you understand? Bottom line, do not rely on one just analysis. Apply each one with needed. When needed, yes. Bottom line, do not rely on just one analysis. Apply each one when needed. Simple. So don't just like me. Let me use myself as an example. I am a technical forex trader. I use price action to determine the market, either it will go up or down. Understand? But when it is news or fundamental time, or there is a news to be released in the US, in Canada, or if you think it's a high impact news, I'll go there, analyze my chart, and then move direction of the big players. That's all. After that, you just come back from the fundamental, stay true with yourself, with your technical, be better and then be better and be better, be better, be better each and every day. You understand? That's literally it. And then respect chart pattern, supply and demand levels when formed. Also, take caution in time of high impact news and gauge the feeling in the current market. Follow price and money will follow you. This is very, 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 very serious. Just follow your chart pattern, your supply and demand level. Your supply and demand level. Also, caution, high impact news. How you feel about the market. Just let market comes to you, and then the market will reward you. Money will definitely follow you. What this simply means, just respect your analysis. Believe in yourself. Wait for markets to come to you, and then that's it. The patience you will get for the market is what the market is going to reward you from that. Let's move on to the fundamental, which is a little bit lot. The fundamental analysis. This analysis that has to do with the overall state of the economy of any country. So the fundamental analysis is the overall state of an economy of any country. So the fundamental analysis basically deals with the economic activity of any country. For traders has over time capitalized on the internet relationship of some of these key indicators to predict the strength of the economic and by extension its currency. It then means that if we are able to appropriately link the various macroeconomic indicators such as the gross domestic product, the GDP, the inflation rate, otherwise called the consumer price indicator, the employment change, interest rate, the house production earning, then we will stand a better chance to predict price movement in the market. So from the macroeconomic indicators up to this point, they are all some of the economic activities of a country: the gross domestic product, the inflation rate, the economic change, the interest rate, the housing, the production of a country. All this helps in predicting the market movement in the fundamental part of the market. As we have learned the various type of analysis, fundamental analysts do not concern themselves with the study of charts and its analysis, but rather base their judgment on the recent happening in different countries of the world. So the fundamental analyst do not even look at the chart. What they only look at it and judge based on the recent happening in a country. Do you understand what is happening in a country right now? What is happening? Maybe there is a low employment rate. Okay, if there is low employment rate, that means the US is weak. So every pair that the US is the base, I am selling it. That's what basically they do. They don't have nothing to do with the technical analysis or the chart. So let us look at some of the common fundamental news release that can influence market price. So there are certain all this news release. There are some that directly move the market like hard. They move the market like they punch the market and they move the market very hard. So let me plug my phone. Okay, so one is the gross domestic profit. So that's the GDP, gross domestic profit or gross domestic product. They are all the same. So it is a measure of the total output of economy. If the economy is doing well, then the GDP numbers. If the economy is doing well, then the GDP numbers, the GDP number in percentage will be greater than the expected value. So in a country, when the GDP, that's the gross domestic profit or product, is doing well, is good, then the percentage will increase. You understand? When it's doing well, the percentage will increase than the previous one. Maybe the previous in the previous ones, the GDP was not really doing well, but currently the GDP is doing well. That means there will be an increment. Do you understand? So when this happens, investors will have confidence on the economy, and this consequently causes the local currency to strengthen. If the GDP figure is less than the expected value, there would be a depreciation in the country's currency, as such currency will be bearish relative to other economy. So from the first one, when the economy is doing well, when the GDP is doing well, that means the percentage now will increase more than the previous one. And when it is not doing well now again, that means the percentage will also decrease. Do you understand? The percentage will also decrease. And the second one is the inflation rate or the consumer price index. When the inflation, bro, you know how inflation is crazy in Ghana. This is the general and the persistent rise in price level. This is not too good for the economy, as a consumer real income reduces. When cost of production rises, then the producer passes the cost to the final consumer, making them to pay more even when their income has not increased. So this is the real inflation. Bro, this is what is happening right here in Ghana. This is what prices of goods is high. Do you understand? And when prices of goods are high, production will go high. And when production go high, or the final product, the cost. Hello? Hello? That's all about the inflation or the consumer price index. So inflation is assumed when CPI, which is capture the price of bucket of common goods over a period of time. If this number in percentage is greater than the expected level, then the currency of that country will fall at that moment. Inflation measured with CPI. So anytime you see CPI, so there's a CPI news coming, that means it is inflation news that is actually popping up. Inflation news that is popping up. So the inflation news, when the inflation news goes up, that means that state currently the currency or the inflation rate in that state is high. and when it goes down, that means the inflation rate of the country is low. When it's low, that means it's good, and then when it's high, it's bad. So if it is less than expected, then it is positive. As I said earlier, inflation, if it's high, then it's crazy, bro. But if it's less, then it is a positive on our side. So we just have to understand the different types of the news when they are about to release. The GDP basically means the productivity of a country. So if the productivity of a country is up, that means it's good. But when it is low, then it's crazy. Then it is crazy. And then the CPI is also about the inflation. So with the inflation, when inflation is high, then it's bad. But when inflation is low, then it's good for a certain country. So you can also capitalize on the CPI news and then also make some profit out of it. So buyers get ready to go long on the currency of that country relative to the other currency. So when the CPI, that is the inflation news, is less, that means it's positive. So when it's positive, we buy. You understand? So every currency, let's say in the US, the CPI news or the CPI, which is the inflation rate, is low. That means I have to buy the United States dollar right now because the inflation is low. When it's low, it's good for the economy. And then the third one is interest rate. The interest rate. So what is the interest rate? Interest rate is determined by the central bank of any country. The interest rate, that's where it's dealing with our money right now, is determined by the central bank of every country. It is the key rate that is used to regulate economic activity in the country. So the interest rate is the key rate that is used to regulate economic activity in the country. So the interest rate, you can see when you are going to deposit your money in a bank, they say maybe when you go for treasury, they say the interest rate of the treasury is this. But the actual sense is that when you put your money on a treasury bill, your money is put into work, meaning your money is taken and then the bank will invest it somewhere. You understand? The bank will go invest in the stock, in the market, and then when profit is made, when huge sums of money is made from your money, and then they have a fixed interest rate for you as 10%, as 20% based on your money or your deposit. So let's say for instance, if you deposit your money as a treasury bill, a money of let's say 10,000 Ghana currency. You understand? So 10,000 of Ghana currency, and let's say the bank is giving you an interest rate of 1 year as 10% of that your money. Do you understand? Which is what did I say earlier? The 10,000. Let me just use this. So the 10,000, which is your money, you have used it for the treasury bill. Do you understand? This is your money you have used for the treasury bill, and the bank a year is giving you 10% of your money. In 1 year, is giving you 10% of this. In a year, the basic knowledge is this: your 10,000. You just calculate 10% of your 10,000. So you say, oh, it's good. I'm just getting 10% of my money in every year. So every year I'm going to cash out this. It's good for you to say that, but the actual sense is that this 10,000 is put into work. The bank will put this 10,000 into work, and when this 10,000 is put into work, it's put into work in a sense that the bank will invest it in the market, will invest it in the stock, into forex, into bit, all those investment stuff, the bank will invest, and the bank will be making maybe a return of 50%, almost 50% of your money. The bank will be making a profit of 50% on your 10,000. Do you understand? It is not even a year, maybe let's say a month. The bank is making 50%. And with this 50%, the bank is giving you a year 10% of the money. And you think it's cool. Bro, it's not cool. It's not cool. The moment I get to know this, I'm like, no, bro. I will not like put a huge sums of money in the bank, just be sitting in the bank. I'll just rather put it into work and then make a lot of money from it. Maybe put it into real estate. No, I'm a boy.
Rice.
So you can rice. Yes, sir. Now, anyway, I will bet you. So when I get to know that this is what the bank basically do, and then they will be giving us this little interest, I'm like, no. So if you have like a very huge sense of money, but you have to put that money into work. You have to maybe get a house, renovate it, scale it up, and then maybe sell it or rent it. So if you have maybe $1,000, or maybe let's say $2,000, with the $2,000 you can own a home or a house. Do you understand? Buy it, documentation, and it's in your name. When it's your name, it's for you. Renovate it, modernize it, and then either sell it off or rent it. And then within that 1 year, you are going to be making more than that 10% of what the bank is giving you. It's basically simple. I just want you to dig deeper upon the interest rate of Ghana Commercial Bank, and then just sit down and then calculate. Maybe just do an estimate. Maybe if I have maybe $2,000, and these $2,000, when I put it into treasury bill, the bank is giving me maybe 10%, 20%, 30%, and every year. Okay, in every year, this is what I'm making. Okay, this is what I'm making in every year when I put my money in the bank. And now when I put my money into work, maybe if I get a house, renovate it, remodernize it into our current state that everyone would like to stay inside, I'll be investing maybe with that $20,000. I'll be investing maybe $19,000. So I have only $1,000 left with that money I use for that investment. And then after your first rent, you can even rent it, maybe even not, if it's not closer to your 20,000, maybe half of it or more than half of it. And if this keeps on moving, if you keeps on moving, you can see within a year you'll be making like, oh bro, you'll be making like more than what you initially invested in that business or that thing. So the interest rate is just crazy. And then the non-farm payroll, which is the fourth one, the non-farm payroll. This is the total employment in the United States. So when you say the non-farm payroll, it means the employment rate in the United States. Only the United States have this. So the non-farm payroll, which is released the first Friday of every month. So the first Friday of every month, the non-farm payroll is released to know the previous month, what happens in the previous month. Maybe the employment rate in the US goes up, the employment rate in the US comes down, you know. So with that, you just capitalize on it and then just make profit out of it. Okay, let me read it. It does not include farm work, private household employees, or non-profit organization employees. A, fig- a figure greater than the expected value is good for the economy, hence, rise in value of the dollar should be anticipated. So, when the employment rate is increased, so when the employment rate is increased, that means it is a good news. And when it's a good news, meaning you'll be buying the dollar. Definitely, the dollar will be rising because there's an increase in the employment rate. Definitely, we will be buying because it's a good news. So, for instance, if we get a less impressive employment change than we should expected, the US is going to fall. So, when we have a less or a small employment growth, that's the NFP in the in the US, when the employment rate is less, meaning that where the US currency is the base currency is going to fall. Do you understand? Because it's less. So if the US currency is the base currency, it's going to fall. But when the US currency is the coast currency, it's going to rise. That's basically it. And then, how can we read the economic calendar? So the economic calendar, how can you read it? We have the red folder, we have the yellow folder, and then we have the orange folder. So the red folder indicates the high impact news, and the yellow folder indicates the low impact news, and then orange folder indicate the medium impact news, and then the medium impact news and then the low impact news don't really move the market. So you can see this yellow bar is the low impact news, and then this orange is the medium, and then this red one, it is the high impact news. And where we can find all of this is the either the forex market, the my FX book, or investment.com. Yeah, by me, I use the forex factory. So let me try connecting this, and then let's go to the forex factory, and then let's see. Maybe it's a link, so we can go there. Let me connect my Wi-Fi and see whether if we can go to the my fxfactory.com. So it's connected. Let's click on this factory.com. Leave it. Let's go. So this is basically how the forex factory looks like. So let's go to calendar. That's it, the calendar space. Let's go there. So that's it. So here is all the news. You can see we have the Australian dollar, the Japanese yen, the Swiss franc, that's the Switzerland, the euro, the pound, the CAD, the USD, and then keeps on going. So the yellow one is the low impact news. You understand? You can see the low impact news expected, and the orange one is the medium news expected, and the red one is the high news expected. You can see the high news expected. You can see the US, the CPI. And what did I say the CPI is? The CPI is the interest, no, is the interest rate or something like that. It's the interest rate. The CPI is the interest rate. So where is it, bro? The what is it? Is the inflation. Is the inflation rate. The CPI is the inflation rate. Is the inflation rate. Is the inflation rate and then GDP that we said earlier. So you can see, let's use the CPI here for example. So with this CPI, you can see this is the forecast. I want you to know this is the forecast and this is the previous. The forecast means what we are expecting, and the previous means what has happened earlier, and the actual means right now. When the news was released, what was the percentage. So the forecast is what we are expecting, and the previous is what has already happened, and the actual is what we are expecting. The actual is what we was forecasting that it will happen, and what actually happens. That's all. So with the CPI, which is this one, we can see the forecast. The previous was 2.6%, and then now the forecast was also 2.6%, and the actual what was released is 2.4%. That means now I'm just saying different thing, bro. This is it. The CPI, the forecast was negative 0.4%, and the previous one there was no percentage on it, but the forecast is it will decrease. The inflation rate will decrease to negative 0.4%, but the actual thing is what really happened is negative 0.3%, and which is good news per the inflation rate. And when inflation rate is low, we buy. You understand? That's basically the inflation rate. And then we have the gross domestic profit. So the gross domestic profit, this was the forecast, 0.2%, and the previous one was negative 0.4%, and what really happened was 0.5%. So it's an increment. It's an increment. That's why we have it is in a like green color. So the GDP, meaning the production has increased, meaning we are buying all pound currency. We are buying all pound currency. So that's it. If you have a little bit of misunderstanding with this one, or you want a little bit insight on this one, just hit me up, and then we're gonna talk after you're done with it. So that's it. So let's move on to the technical analysis side of the market. Okay, technical analysis side of the market. So with the technical analysis, as we have already explained the fundamental analysis and the sentimental analysis, this is the technical one. So the technical analysis, we deal with the trend and flat. Flat means it is consolidation. It is consolidating. It is consolidating. So trend is a market condition of price to move in a particular direction over a period of time. So when you say a trend means when market keeps on moving in a lower low, high low, high, higher low, higher high, higher low, higher high, higher low, higher low type of formation, meaning we are in an uptrend. You understand? The trend means a condition that a market is moving. So when the market is moving in this direction, when market is moving in a low, a high, lower low, lower high, lower low, lower high, meaning we are in an uptrend. And then before we can say we are in an uptrend, market has to move in this direction. Market has to be going up this way. That means we are in an uptrend. And what you can really see, what do you see before you say we are in an uptrend? Is a series of higher high and higher low type of formation. You understand? And the higher high and higher low type of formation is this, and market moves in this direction, when market keeps on moving in this direction, that means we are in a higher low, higher high and higher low type of formation. So every time price reaches move impulsive, we trace to the backside. So here is the low of the trend, and here is the high of the trend. Because market is pushing to the upside of the market, and price retraced to the downside like this, here become the lower, the higher low, because we are moving in the higher, or we are moving in an uptrend. When market moves up like this and then moves backwards, here become the high, and here become the high of the low. Here is the high, and here is the high of the low. And when market moves past this high, that means we have created a higher high. That means this high is higher than this. And when market retrace back down again, we say it's a higher low, because here is the higher high and here is the low. And when market moves past this high again, we are in another higher high. And when market moves down to this level again, here becomes our higher low. And when market moves past this level again, here become our higher high. And when market move down here, push up, here become our higher low. When we see this type of formation, it basically means market is moving in a uptrend. That means market is moving in a particular direction. That means the higher or the uptrend, the higher trend or the uptrend. And when we see market moving a lower low, a lower high and a lower low type of formation, that means we are definitely moving in the lower side of the market, or we are in a downtrend. Do you understand? You can see market moving. Here is the high, because here is at the top, and here is the low. Here is the low, and market will chase to the downside. Market will chasing to the downside. Here become the low of this. Here become the low of this high, and then here become the lower high. Here is the lower high, and here is the lower low. My G. Yo, I'm back. Let me start explaining this one again. So this is the uptrend. When it's going up, it's an uptrend, and then when it's coming down, it's the downtrend. So with the downtrend also, when, let me clear this one. When you see price start moving in a lower high, lower low type of formation, when price start giving you a series of lower high, lower low, lower high, lower low, lower high type of formation, then that means we are in a downtrend. You can see here is the high and here is the low you have created, because price here is the high and here is the low. Do you understand? And then price will trace backwards here. So here is the low. So here become the lower high of the low of the downtrend. And when price move past this one, here becomes the lower low. Here becomes the lower low. And when price retrace, let me extend this one. And when price retrace backwards again to the downside, here become the lower high again. And when price move past this previous lower low, here become another lower low. And when price retrace backside, here become the lower high again. And when price break out to the downside, here become the lower. That's how basically it works. So when you see market moving in a series of higher high, higher low type of formation, it means we are in an uptrend. And when you see market moving in a lower low, lower high, lower low type of formation, that means we are in a downtrend. Yes, or the bearish side of the market. If it's uptrend, traders say it's a bullish trend, whereas if it's in a downtrend, traders say it is in a bearish trend. So when the market is in an uptrend, we say it's a bearish side, it is a bearish movement. And when you say it is moving in a downward trend, we say it is in a bearish movement. When we say when market is moving up, we say it's a bullish movement, and when it's moving down, we say it's a bearish movement. That's basically it. The trend can be spotted by visual observation or by connecting two or more peaks or troughs in the market. So this trend, before you can see the trend, you have to you can be visual observation. You can see high low, high low, higher low. That means in an uptrend. Lower low, lower high, lower low. That means we are in a downtrend. Or you can connect to see if market. Connecting means using trend line to also connect, and that's in the trading view, the app. And then trend can be long term, immediate. Trend can be long term, immediate, or short term. Success in the forex market. Success in the forex market can be tied by ability to identify trend and take positions in trend in line with the trend. So before one can be a successful forex trader, you have to go with the trend. When the market is moving uptrend, when the market is moving uptrend, we go with the trend, and when the market is moving downtrend, we also go with the trend. There is a popular say by traders: the trend is your friend. Never forget the saying. If you are able to remember it and apply it in your trading, money will come after you. So when you are able to understand that the trend is your friend, when market is moving up, we go with the market, and when market is moving down, we go with the market. When market is moving up with price action, meaning the big players are moving the market, and when the big players are moving the market, we basically go with the big players, and when the big players are moving the market to the downside, we also go with the big players, and that's how you can make money from the market. So trend can be spot using price action, trend line, moving average, crossover, and combining more techniques. So before we can spot a trend, we have to use price action. That's the technical analysis before we can see that price is moving up or either down. So with the combination of our tools, the trend line, the horizontal line, the vertical line, all the technical tools will also help us to know if market is moving up or down. And then we have a section which is the flat. So when you say flat, it basically means market consolidating at a certain point for a very long time. The market is consolidating at a place for a very long time. The market keeps on consolidating here, like this. Oh. So when market keeps on consolidating like this, we say it's flat or consolidating. We can say flat or consolidating. So that basically means market is consolidating or market is flat. This is a market condition that is either rising nor declining. You can see it's in between this horizontal lines. Its market is not going up, market is not going down. It's just in between them. That means it's flat. When the market does not have a specific identifiable direction, the market is said to be a choppy or moving flat. Some people also call it a choppy market simply because the market has not given any direction. It's just moving in between these two horizontal lines. There are various names which can be called among which are sideways movement, ranging band consolidation. So some people will say the market is in a sideways movement, the market is in range band movement, the market is consolidating, the market is flat, the market is swinging. It's basically the same thing. The market is moving in this movement. The market is moving in between this support and this resistance. These two red horizontal lines, the market is moving in between them, moving up and down, up and down, up and down, up and down, up and down. In between them, we say the market is either in a range, it's flat, consolidating, moving sideways. So one thing is that it is that I'm not going to read all this one, so that you just skip today. So one thing is that when market is moving in this direction, you just stay out of it, because you don't know the direction of the market. We only say trade with the trend, and when you are trading with the trend, it's either the market is going down or going up. And when the market is not going up or going down, what are you basically doing in the market? Nothing. Do you understand? So basically stay out of the market when you see market in a range or consolidating or moving flat this way. Now let's move on to what is a support and a resistance. So when we say a resistance or a support or a resistance, a support or a resistance, this when market keeps on moving this way, and when market reach here and then bounce up, reach here, bounce down, reach here, bounce down, reach here, bounce down, reach here, bounce down, goes down, come back, bounce down. This line here is called the resistance. This line here is called the resistance. Why? Because anytime market reaches at that point, market keeps on coming down. Anytime market reaches that level, market comes down, market bounce back. Anytime market reaches, market bounce back. So we determine this point as a resistance. And when we say a support is when market reach this level, it bounce up. When market reaches this level, it bounce up. When market reaches this level, it bounce up. That is the term as our support. So we have the support, and then we have the resistance. So anytime price reaches here, it bounces to this support here, and when price reaches this support, it bounces to this resistance. And when price reaches this resistance, it bounces to this support. And when price reaches this resistance, it bounces to this support. And when price reaches this support, it bounces to this resistance. That's how basically what a support is and what a resistance is. So let's read the material. This is the backbone of the technical analysis. Funny enough, everyone seems to have their own ideology as regard the plotting of support and resistance. Here is how it is like. So here is a support, because here is where price gain a support and then move up, and here is where price resist and then move down. Here is where price gain support, move up. Here is where price gain support, resistance, move down, gain a support, move up. You can see this market. We can identify that this market is in an uptrend. Do you understand? So anytime when since price is in an uptrend, anytime price reaches a certain point, price has to resist, come back for a support again, and then move in the direction of the market, which is the uptrend. And then let me clear everything. That's basically the support and resistance, what the support and resistance means. So some people call the resistance a ceiling, some people call the support a floor, some people call this support floor, some people call it a ceiling, some people call it a demand, some people call it a supply zone. So they have basically a lot of names for the support and then resistance region. I don't want to waste a lot of time, because this, when I explain it, you just get it, and then when we move on to the main chart, you also get it more from that point. And then bear in mind that you can't just draw support and resistance anywhere that you want. We have the random numbers on the chart, the training view, but you specifically have to know where you want to draw your support or your resistance level at right there. So that's just it. So let me read this level for you to also understand. Support and resistance is not just a random area where price turn around. There are potential sellers waiting to go short or sell at a resistance point. So you can't just play your support at any point, anywhere you play your support or resistance, you just play your support. No, it doesn't happen that way. A support and resistance is a place where when market reach that point, market has potentials or has a potential of either dropping down or moving up. Do you understand? Market has the potential of dropping up or moving up. You don't have to draw your support and resistance at anywhere that you want. Also, there are potential by waiting to go long or buy at a key support area. All these buyers and sellers work together to send price lower and make up the supply in the supply and demand equation. More sales than demand, price falls. More demand than sell, price rises. So what this basically means is that when there's more supply than demand, price will fall. And then when there is a demand than the supply, prices also rise up. So that's basically, when we say a resistance, we basically means a support, and when we say a support, we basically mean a demand. Okay. Most of traders base off their trades on support and resistance principle, and it is proven way of trading in the forex market. So this is what I really like to do in the market, which is the support and resistance. Most of the traders based on their analysis on support and resistance principle, and it is a proven way of trading the market. A very, very proven way of trading the market, because everywhere there is a potential sell and everywhere there is a potential buy, which is the support and resistance, market will turn right from there. So that's period it. When there's a potential and market moves here and then reject, gain a support here, this is a support, and then push up, do it own thing, do it own thing, because here is a support level, and when market drops down, market has the potential of pushing back upside again. Do you understand? Here becomes this another support again. So you just buy right at this point and then push the market upside, because here is a potential buy, and when market, here is the resistance, and when market come back here for the first time, do it all thing, goes up, goes down, and then revisit this level again, because market has the potential of dropping once again, because it has already happened. And we said we use past history to determine the future, what will happen in the future. Market will has higher potential of it dropping to the downside. So that's basically the support, the basic knowledge of the support, and then resistance, and then ways to draw support and resistance in the forex market. Ways to draw support and resistance in the forex market. I'll not just read it, let's go straight into this one. So this is it, another powerful way to draw support and resistance. One is select any of your favorite pairs. So when you go to the forex chart, the trading view, you will select any chart and then follow the process as you read the guide, so you can get along with it. So 2 is mark out swing high, that is the peak, and swing low, that is the trough. This can be done by placing a line at this level. So when we go to the chart, where market create a high, we mark it, and where market create a low, we also mark it. So the high is our resistance and the low is our support. Simple. So you can see from this image that here is a resistance. Why? Because when market touch this here, market drop down. Here is a support. Why? Because when market reach this here, market push up to the upside. Here is also a resistance. Why? Because when market reach here, it drop, came back here, and then drop all the way here. Here is a support. Why? When market reach this level, market push up. Here is a support. Here is a resistance. market dropped, here is a support, market pushed up, here is a support, market pushed up, here is a resistance, market pushed down, here is a support, market pushed up. So that's basically the support and resistance, the turning point. And then with it, if you want to identify them, you have to connect the high or lows using a horizontal tool on trading view or trading terminal. So we have an horizontal tool in the trading terminal which we use in connecting the high and low. So when we get there, I'll also show you from there. So from now, from this point, we are going to deal with the what do you call it, the high and low. What is the resistance and then support in the trading view. So that's basically this one. And then I don't want to touch on the moving averages now, because actually I don't know a lot about the moving averages. I'm actually learning some of the moving averages. Yeah, I'm actually learning some of them, so I don't want to touch on it, but I want to touch on channels. So when we say channel, is formed by connecting at least two consecutive swing low and swing high using trend line. So when we say a channel is when we are able to connect two consecutive swing low and then swing high using the trend line. That means price channel is a trading technique that is borrowed from a traditional trend line. Trade signal is taken if price break any of the parallel trend line drawn. So some people trade in the channel way. That's the in the channel way. When the price is moving down, they will just draw a line. When the price break out of it, they just enter the setup. So I'll just show you the channel, what a channel is, so that when you see a channel, you can know, okay, market is moving in this channel. We have channels and we have patterns. You understand? So as time goes on, when you see something, this is not regular, so what is this? It's either a channel or a pattern. So with combining with support and resistance and Japanese candlestick pattern, often a great trading system. This system requires a lot of practice and analyzing the market structure. So we combining support and resistance and then Japanese candlestick pattern. The Japanese candlestick pattern is also an app, and then I'll be sending it. I'll be showing you so that you can also download it and also learn some names. When candles form, we have some names given to them. You also know the meaning and then also get equipped with it. So now bear in mind that we say we have a resistance and then a support. This is a resistance and this is a support. When a support is turned this way, it's still a support. And when a resistance is turned this way, it's still a resistance. When price gets here, it pushes up. When price gets here, it comes down. When price gets here, it pushes up. When price gets here, it comes down. It's still the support and resistance we know. It doesn't change the name. It doesn't change nothing from it. It's still support and resistance that we know already. So you can see here is the channel. So this is the channel. This one is the channel, and then price eventually gain a support here. Here is support, another support here. Here is a resistance again. So when price gains support here, push upside, break out of this one, and then push upside. You see, here is a support, here is a resistance. You understand? Price eventually end up pushing this. So here is a resistance, and then here is a support. Price pushed up, break out of this level, and this level is a resistance. You understand? Break out of it, push up, come down, and then push up. So this is an uptrend, and when uptrend is created, this is the low and this is the high, and now here tends to be the higher low of the trend. Then after here because to be the higher low of the trend, and then so on and so forth. So I think here will be where, let me see, here will be where I would like to end. So the Fibonacci level as time goes on, I will just explain it. But the Fibonacci level is just something real quick. I'll just make you understand, just something real quick, and then makes you understand. The Fibonacci level is like a tool. It's also an indicator. But for the Fibonacci level, I used it sometimes, not all the time. Sometimes, not all the time. So where it requires a Fibonacci, I also show you what a Fibonacci is. So okay, let me actually add it. So the Fibonacci level, this is a combined to use by the technical trader to spot reversal or continuation area of the market. So maybe the market is moving in an uptrend. When the market is moving in an uptrend, market has moved in an uptrend for a very long. Let me do it in the right way. Market is moving in an uptrend for a very long time. Do you understand? This is it. And then here is the low, and here is the high. Do you understand? Here is the low, and here is the high. And we want to know the reversal, where the reversal can push up to before this this continuation to the upside. That's where we use the Fibonacci level. You want to know where price will trace up to before this spike or this move to the upside. So that's how we use the Fibonacci. It has numbers. So we just take the tool, drop it from this low, open up to this high, and then it will show us levels here. So when price reaches that level, and then it is cool, it will respect it and then push to the upside very, very nicely. So that's the Fibonacci. This is just me talking about the Fibonacci, but practically I will show you what the Fibonacci is, or I also make you go and watch one YouTube video of mine so that you also know the Fibonacci. But definitely I will also show you with Fibonacci on the next one, because the next one is going to be a practical, and me show you how to do the support and resistance level, the market trend, the channels, and then the what do you call it, the Fibonacci retracement symbol. So that's it for this video. I know there will be a lot of questions coming from this one, but when the practical side is released, when I send the practical side to you, which is basically the trading view, I'll go over the trading view and then start explaining the support and resistance, and then that's it. What I've said earlier, the support, resistance, the Fibonacci levels for you guys to understand. Then from that point you will be very clear. So from you understanding support and resistance and being able to indicate support and resistance, then from there, that's how we go from there. So that's it for this video. I hope you find value from this video also, and then let's keep it rolling. So see you in the next video.